Welcome to another episode of Money and Medicine. Today we are going to discuss retirement annuities, what to do with your retirement annuity if you hit the age of 55 or if you want to retire after that. What is your options? What can you look out for? And what are some of the key decisions that you will have to make? Right up next. So if this is the very first time that you are watching Money and Medicine, please go to our website, www.moneyandmedicine.co.za. You can also check us out on social media, Instagram, Facebook, and you can check out some of the information and some of the content that we've put out there. We've got some free resources, tools that you can download on our website to make sure that you can make the best decision for you and your family and the ones that you love. All right, so when you hit the age 55, we get the question quite often, what is my options? Or if you are currently still young and you're looking to save towards retirement, you want to make sure that you do it in such a way that when you hit that retirement, that you can operate in the most tax efficient way possible. But before I get to retirement, let's maybe talk about accumulating towards retirement. So the typical options that are available when you start retiring or when you start planning for retirement is, first of all, a retirement annuity, which is something that you would take out in your personal name. Secondly, there's what we call a pension fund, which is where there's typically an employee-employer relationship. So you would be part of a group pension fund. And then thirdly, there's what we call a provident fund, which is also an employee-employer relationship. The only difference between a provident fund and a pension fund up until last year was that a provident fund will vest 100% of the capital in cash at the age of retirement, or a pension fund will only vest a third in capital, and the remaining 2/3 has to be reinvested in an income. All your contributions up until 2021 will still be 100% available as a cash benefit, but after that will be subject to the same rule as a pension fund, which is a third in capital and two-thirds needs to be reinvested in an income. All right, so all three of these vehicles have retirement option from age 55 onwards, and now what? So let's say, for argument's sake, Joey comes to the age of 55. And Joey has a retirement annuity, a pension fund, or a provident fund. Let's just say, for argument's sake, a retirement annuity. He has one of two options to execute. The first option is that money can be 100% allocated towards an income. And the second option is a portion of that can be allocated towards an income, and a portion of that can be vested as a cash benefit, which will be subject to retirement tax. The max that you can get as a capital benefit is, as per current legislation, a third of your total capital. So if you've got 900,000 Rand as an example saved up, 300,000 Rand will be paid as a cash benefit, maximum of a third. So you don't have to take a third, just a maximum of, and the remainder will be paid towards what we call an income or an annuity. If you look at your options available in an annuity, there's again two options to pick from. There's one which we call a living annuity, and there's one which we called a guaranteed or a life annuity. So a living annuity is, let's say, for example, you've got R1 million that you're allocating towards an income. This is where you then physically go to the market. So you will approach the likes of Alan Gray, 91, PPS Investments, Sanlam Glacier, whatever the case might be, and you would ask them to draft a living annuity plan for you where you withdraw a portion of your total capital that you've invested with them on a monthly basis. The limits that you can withdraw from the total capital is anything between 2.5% and 17.5% as per current legislation. So if you've got R1 million in there, you can say, well, I want 2.5% of that R1 million paid to me, which is 25,000 Rand, and that needs to be paid to me in a monthly basis for the year, or you can do a quarterly payment, half yearly, or an annual payment, depending on which platform you're going with and depending on what they allow on that platform. It's important to note that you have to withdraw. So you can't go, I want to park R1 million in my living annuity and I don't want to withdraw from that living annuity. The minimum that you can do is 2.5% as a drawdown. That income that you draw down from there will be subject to normal income tax tables. So you will pay tax on that income that you do receive. The second option is where we look at a guaranteed annuity. So this is typically where you approach an insurance company. It's not only insurance companies. There are other investment companies out there that also look at this. But in general, you take this same R1,000,000, you go to them and you ask them what is the best income rate that they can give you for this R1,000,000. They normally take your age into consideration, various factors into consideration, and whatever their rate is for that week, and they issue you with an income. The income that they give you is guaranteed for the remainder of your life, so you will never ever run out of capital, even if you become 200 years old. The downside to that is just your capital can be lost in the event of death. So basically the capital will die with you. It is important to understand that you can build in safety nets into this mechanism, but the more safety nets you build into it, the more you're reducing your initial income. So for example, the highest income that you can get is you take your R1,000,000 to them, you say, I don't want any escalation on my income annually. So if you receive 10,000 Rand a month, that 10,000 Rand a month will stay level for the remaining of your life. You will, however, never run out of capital. The other option is also to say, well, I want to start introducing guaranteed periods, which means that let's say you've introduced a 10-year guaranteed on the guaranteed annuity benefit. It means that should you die within that 10-year period, that income will still pay out for the remainder of the 10 years. So if you die in year 2, there's still 8 years of income guaranteed to whichever beneficiary you nominate. You can also take out a joint life option. So this is typically where it's 2 spouses, and if something happens to you, that benefit will pay to your spouse up until your spouse is deceased. So you make sure at least that both parties have enough income for the remainder of their lives. You can also introduce an escalation on your income, so you don't have to receive that 10,000 Rand forever. That 10,000 Rand can increase with inflation every year, or 3.5% or 5%, or whatever you nominate. Obviously, the higher your escalation, again, the more you're sacrificing on your income. The longer your guaranteed period that we spoke about, the more you're sacrificing in your income. Also, if you start introducing a joint life, like with a spouse, again, you will be sacrificing on that income. So that is just in general more or less the 2 that you will be getting. To take a step back, if you look at the capital that you're taking as a cash benefit, so again, you've had 900,000, if we can go back to that example, and you withdraw 300,000 as a cash benefit. That 300,000 Rand will be taxed as per the retirement lump sum tax tables. As per current legislation, the first 500,000 is totally exempt from local taxes. So it is important to try and max out that 500,000 so that you can get that benefit as a tax-free benefit. And that money you can either reinvest, you can settle debt, whatever the best financial advice would be at that point in time, you can implement to make sure that you do retire comfortably. So in closing, what is the best option? Well, these days the market offers a blend between the 2, which is something that you can explore. So you can look at what are some of those fixed expenses, maybe like a medical aid, something that you won't compromise on, and make sure that at least that base you offer in a guaranteed annuity. So you make sure that your expenses would be covered for the remaining of your life. You're not exposed to financial markets. You don't have that stress that there's fluctuation, a war breaks out, there's politics and stuff that just influences your hard-earned retirement savings. Then what you can do is you can also take a portion of that into like a living annuity, because you've got the flexibility. So you can decide which drawdown you want. Maybe for year 1, you want to start with a 4% or a 5%. And as your income goes, as you age and as you start growing older and getting closer to your latter years, then you can start increasing and ramping up that living annuities drawdown to make sure that you live the life that you always wanted to live. It is also important to note that the living annuity can always be transferred into a guaranteed annuity, but a guaranteed annuity can't be transferred back into a living annuity. So again, a living annuity just offering that little bit more of flexibility. So I hope that helps you with the important decisions of retiring. Obviously, there's a lot more to discuss and unpack. What happens if you're in a provident fund? What happens if you're in a pension fund? And we can talk about that in future episodes to come. And also, if you've got non-retirement savings, maybe you want to sell your house, maybe you're looking at discretionary investments, and how does that feed into your total retirement plan? I hope you found this episode useful. If this is the very first time that you're watching this, please go check out this video where we talked about asset classes. This will also unpack some of the growth mechanisms within an investment, and also look at this episode where we looked at tax efficient investment vehicles. Until next time, plan the plan.